And we are live for another completely unmissable Sunday show. And it's Memorial Day weekend. It's the 6:45 Eastern on Sunday, May the 24th. Welcome to Benny and the Squirrel. Hi, Benny.
Happy holidays. Looking nice there in the Hong Kong Bay.
It's like a Turkish bath out here. It's so humid at the moment. It's Buddha's birthday as well today. Squirrel's birthday on Friday. Buddha's birthday today. So it's a holiday here too, actually.
Good, yeah. All right, let's get into it. Well, before we get into the SpaceX, we will mention that crude is down 5% on the open. Apparently some deal, or rumors of a deal, or images of a deal, or maybe guys are just taking advantage of little weekend sentiment and jacking it down so that Rupert can buy it. You know, who knows?
Yeah, I think I've been slightly torn on this one. I've done absolutely nothing at the front of the curve throughout all of this. In fact, it's been ages since I played crude at the front of the curve. It's just so insanely volatile. But I think at some stage, I was really hoping for the proper deal dump in crude to just rack up some BNO, the ETF that basically rolls the front month Brent future, and I think you can sit in that, for the next 18 months as the real energy crisis plays out.
Yeah, I mean,
don't overthink it. But I was really hoping for a sort of proper $10 a barrel dump here, but yeah, a lot can happen between now and when the cash market opens on Tuesday. So let's see.
Yeah, I mean, look, from just a human standpoint, I would like them to get this fixed, right? You know, I mean,
Please.
yeah, because the super El Nino coming, it's a dangerous cocktail, and I know it's already going to be tight because of what's happened. I mean, Rupert, well, you remember that first night we were broadcasting when the war started, and right, I was at Dubai. That's damn near 3 months ago now.
I know.
Wow.
It's incredible. Anyway, we've got a packed schedule to get through. I'm hoping that people had a chance to see the note that I put out this morning Eastern time, so Sunday morning Eastern time last night in Asia. We're gonna break that down on the Sunday show, and Benny's been kind enough to put together some slides while I was asleep. This S-1 is, I think, the most remarkable document that I've seen since WeWork, right?
And there's people saying that, right? Like they're saying this is literally like, what was it? It was like, there's only we. And there, remember that they had one page dedicated to some stupid quote. And it was just like,
well, I think you've picked it up with there. That this is it was almost the same word, wasn't it?
Yeah.
But we replace we with consciousness.
Yeah, right? Exactly. We must extend the light of consciousness to the stars. Remember when Facebook went public in 2012, and they're like, "We're gonna connect the world, and we're gonna connect everybody. It's connect." Like, and that is their theme.
And Google was do no evil, right? That was the hype.
Got to sell somehow or another, Rupert, right? All right, so let's get into it. We put out a note. We talked about it a little bit on the live show. Thanks for everyone who came and checked this out. That was fun. And we'll do one of those once a month, kind of going forward. But this is just crazy, man. I had a lot of phone calls and I've done a lot of looking at this thing. And I still can't really believe this is going to happen.
Yeah, I mean, I think the important thing is, right, we've all got a choice not to buy this thing, and just to make it very clear, Penny and the Squirrel are not buyers of this deal. But we're not being curmudgeonly old men to sort of really beat the glass about this one, because for a number of reasons that we're going to go through, this matters to everybody. Right, whether or not you're an Elon Musk fan or not, whether or not you want a piece of the Muskonomy, this is such a major capital markets event, and I actually I mean, I don't think I'm being desperately alarmist when I say that this deal, if it gets over the line, could actually inadvertently just put a double tap straight in the forehead of the S&P, right? And we're going to go into why that might be the case. So, you know, we called the piece "The Physics of the SpaceX IPO," and I promise you, we're not going into the physics of the viability of orbital compute and space data centers. You know, to be honest, it doesn't really matter. Ultimately, you know, that is, you know, a space landlord data center business is not something that you can put a multiple on. And so even if it is built, you still have to apply widget maths in order to buy it. You know, what they're really going for with this IPO pitch, with this IPO story, is the same story as Anthropic and OpenAI. And they are going with this enterprise AI applications TAM of $28.5 trillion, which is order of magnitude about 30 times larger than what anyone else has been saying.
Yeah, we'll get into that in a second. You know, here's the details. You know, if you're on our subscriber list on Substack, we send this deck out. But you know, these are kind of the details. We're coming out at like 1.75, you know, EV, fully diluted market cap, 185 roughly. I mean, you know, it's gonna be 100. I mean, we talked about it when we did the first one of these in early April, that I still find amazing that the green shoe, if they do it at this level, is going to be the 10th largest IPO in history.
Yeah, I mean, listen, ultimately, yeah, this is where scale breaks it. And actually, I think before we go there, I think just a reminder, you know, we're pouring cold water on this right now, but right now, if you look at the poly market odds, you know, 75% of bets placed think that this company is going to close day one with a market cap of north of $2 trillion, right? Which, you know, so the world is really G'd up about this. No one's really fading this, or at least that's what the betting odds are telling us right now.
All the space stocks in general are up and to the right. The ones that trade publicly, they're outperforming the AI stuff. Honestly,
yeah, they have been. They have been for several weeks now. And this is quite an eye test. But this is on the right-hand side of this slide. What you've got is the fundraising history for SpaceX, which is on. This is just taken from notice.co. So it's publicly available, and it'll be in the show notes when we send those around. But you know, this 1.75 trillion valuation needs to be set against less than $11 billion of equity that's been put into this business over the last 20 years. Yes, early investors do enjoy major markups over time out of venture land, but this is a scale of dollars which you know, should make people pause, to be honest.
yeah, I mean, I think that's right. The absolute dollars is like, you know, it's one thing. Hey, we invested at a $10 million or even $100 million valuation, and you know, it becomes 20 billion. Well, you make 200, you know, whatever. This is tough. $11 billion of funds raised, you know, floating at 2 trillion, and it's really, really tough to make the argument for it. It just rubs everyone kind of. I mean, you kind of feel like it's a con job, honestly.
Well, also the other thing about it is, you know, this shouldn't really be viewed like a regular venture investment either, because, you know, essentially they've had all of these contracts from the government throughout the process, right? The government really did a lot of the de-risking, right? I would argue that the equity holders really haven't taken that much risk in return for that markup, right?
I mean, it doesn't seem that way. I mean, yeah. I guess some of them have been in there for a while. You know, like this is not a new company. I think it started in 2002. You know, I think the story is that Elon took his $100 or $200 million. Yeah, I think it was just $200 million.
Yeah,
from
we talked about this before. Yeah,
yeah, he put 100 in Tesla and he put 100 in SpaceX. Guess those worked out for him.
Yeah, absolutely. Let's go back to talking about the core pitch here. The largest claimed total addressable market in human history, as it says in the document. I mean, essentially, this is a narrative pivot for all time, and this goes back to what we said at the start. Ultimately, you cannot get sort of space pixie multiples on any of the core businesses of SpaceX. Satellite broadband. Yeah, well, that's an ARPU and subscriber number business, and you can't escape from that, right? The launch business really is a bit of a fugazi, because the satellite broadband business, is over 3/4 of what employs the launch business. And actually, the growth of the launch business in terms of third-party business is only single digit, right? So it's tough to put a big number on the rocket ship business. And so really, if you've got to believe that this is going to be, the biggest enterprise AI company in the universe, right? With this frankly absurd TAM. I mean, I had a hunt around over the weekend to try and find, third party McKinsey or Bain studies or the others for, total addressable markets for enterprise AI apps. I couldn't find any consultant or market researcher getting to a 2030 TAM number north of $300 billion, right?
Yeah, I mean, let's go to the next slide.
We got 22.7 trillion. Yeah,
this is just, this slide on the bottom right, we put in the note, and it's straight from the S-1. I mean, it's just so stupid. Look at that. Like, those are all good sized markets, and they're like, oh, 23 trillion. So like, 28 trillion TAM is the size of the US GDP. I mean, it's just mind numbing. Anyway, let's go to the next one, though. Go back to the next slide where they have the actual numbers for a second.
Yeah.
You're just looking at a business where the Starlink business is the only real business. Look, if we say, hey, we're renting out data centers and it's a neo cloud, fine, yeah, they're getting $15 billion a year from Anthropic, but that's a data center business. That's not 100 times revenue business, is it? I mean,
and that can stop at 90 days notice at any time, right?
Also, yes, correct. And so, you think about the Starlink, well, one of the things, if you look at, they had a $99 ARPU in 23, 91 in 24, and now it's at 81, and then last quarter of Q1 26 down to 66. So it's clear they're juicing that. And again, I became a Starlink customer. When was that? April or something like that. And I just think that there's going to be a real difficulty in, and here's the math on the Starlink. It's about $500,000 of per satellite, $3 million to put it up in the air. You could argue that the shuttle launch business benefits. So there's a symbiosis to that where you don't necessarily think about the launch business as a standalone, but $3.5 million per satellite, 10,000 satellites, $35 billion of satellites, useful life 5 years. So maybe 7, but like if it's 5 years, that's $7 billion. That's all their EBITDA. So there's no NOPAT, there's no EBIT, right? So there's no economic profit. It's just, hey, you're earning your depreciation, and that's fine. But like it's not 100 times revenue. It's not a 30 times EBITDA multiple business. And then, XAI, he publicly said that they got to redo all the code. I mean, like they're clearly way behind the leaders, and so
you put some walk through that, because you're out on the West Coast, and the gossip machine is all about people fleeing XAI in droves right now. So tell me what you're hearing there.
Yeah, it's basically what I said the other day, is that Amazon and Google and Anthropic are all hiring and XAI engineers, because that's not the top of the stack. I mean, like, guys are leaving, there's issues there. And, it's hard to keep momentum of smart people when you don't feel like you're in the race right now. Right. So it's clear that he bought Twitter with the idea of Grok when he did it, like now. And so, sure, you have access to a good training set of data, but I don't know, like, what is that worth? You didn't execute on the code. You're getting sued all over the place for your nude image. You take a picture and then it makes it nudes. Like, yeah. It seems like it's been poorly executed. Let's put it that way. And so then to like address this whole thing of like, oh, AI, I mean, I don't know. It's just such a stretch.
Yeah. So, I mean, listen, I think we've made the case for the nonsense that is the valuation, but that's not stopped Elon in the past. But I tell you what, this time, really nobody can stop him. I mean, his domicile in Texas has just got a governance moat around him, which just protects him from anything that he basically got away with at Tesla in the end. But caveat emptor, if you are buying this, you literally have signed away all of your governance protections. So really, this is you just have to have a cult-like belief that you're hitching a ride on the Muskonomy, and you're just closing your eyes.
I mean, the idea that he's going to have 41% economic ownership but 85% voting, and then these unexpensed profit or performance shares that he can still collect dividends and he can use his collateral. It's just like, hey, I'm gonna take that rule and that rule and that rule, and I'm gonna put it all for me. And then I'm gonna sell it for $2 trillion. I mean, it's just unbelievable.
And these are already being abused, right? So the connected party transactions, which are disclosed in the prospectus, whether it's paying full rack rate for 18% of the registered Cybertrucks in the US, this sort of sale and leaseback nonsense between Valor and which is Antonio Gracias's firm is interesting. What's your analysis on that, Ben?
I mean, look, I really love the whole SpaceX thing, buying Cybertrucks. I thought that was hilarious. At full price too, by the way, full price.
Yeah.
Right, and a bunch of battery packs as well. I don't have I haven't done enough digging in the Antonio Garcia's thing, but like, doesn't sound good on the surface. And it just kind of goes back to what we're saying, is if he's fortified, there's all kinds of shenanigans that can go on. I mean, I even think the XAI at 250 billion, they ran out of cash. Like, he can say it however he wants, but they ran out of cash. So there's something to be said of like, hey, we're gonna buy it with stock at this valuation, market there, but really they had no cash. So like, if you go broke and you're really smart, you're not worth nothing, but you're also not able. You have no gas in the tank, right? So I don't know. Like,
what's amazing, it's a double remark, right? Because they marked it with the February merger, and now they're marking it up by a further, at least trillion into this deal. With the Cursor acquisition, which is
another 60 billion, right? That was 60 billion, 250 billion.
And that was all Gavin Baker wanted to talk about on this weekend's All In pod. Seriously, guys, public service announcement. All of the Valley and a lot of Midtown Manhattan is already very long SpaceX at those low basis numbers that we talked about. There is going to be a lot of disingenuous shilling. It's at decibel 11 right now. What you got here, that chart there is the private stock on notice. which is still at a healthy discount to the price talk for the IPO. But just pause before drinking the Kool-Aid that's going to be emanating from the likes of the all-in pod. And then, I think we should spend the rest of the show talking about the dynamics on the broader market, because this for me is the big deal. We can whinge like grumpy old men about the valuation and the story and the governance, but at the end of the day, if this deal, both on day one and on an ongoing basis, is going to suck so much liquidity from the broader index, I think there's a real danger that it could break something. Okay, so let's start with the layout. Now, this is in both of my notes, and we updated it just to figure out really, well, to take the syndicate at its word that they're going to find a home for $26 billion of retail demand. That is a terrifying figure in its own right. But essentially, you have got this machine set up to suck just a vast amount of money out of the passive world. So it's over $40 billion on day one of a $86 trillion IPO. That doesn't fix the problem altogether. They've still got to find discretionary money to fill a gap of even if they get the full 25 from retail, they've still got to find another $16.5 billion of allocable demand to get to 1 times covered, right? And if anyone thinks this thing's popping to $2.25 trillion on day one, on a 1 times covered deal, think again, right? That's not how this stuff works.
1 times covered means like there's enough demand to issue the shares, because you don't who's buying it.
Well, so that's a really good point. And so let's talk about this $30 billion of the waterfall here, the captive index demand. Now, the likes of Vanguard and BlackRock and Invesco for the Qs and State Street, so all the big passive managers, they can't put an order in the IPO book, right? Because they can only buy these shares once they're in the index. So the idea is that the hedge fund community is going to explode the prime broker balance sheet on Wall Street by parking this SpaceX stock, for the 2 to 3 weeks of the time it takes for it to get into all of these indices. Now, the Nasdaq's going to be quite quick, but the others there is timing risk, and there's also demand modeling risk. Now, the index, inclusion trade, these guys are getting pretty sophisticated at predicting size, and they're pretty accurate in terms of, days to buy and things like that. They've been doing it for a long time. But, this is a real challenge in terms of physics. And, I'd love to see if we can find, someone who runs a big program trading desk or used to run a big program trading desk that can come on the show and walk us through how they think. So if we've got any followers out there, please send Benny or me a note, because I think that's a topic would be really interesting to cover.
I agree. I know one guy. We can talk about it later. I know one guy who might be interesting.
So I mean, this is the same story again, and you'll get these slides in the show notes in a second. But where I wanted to get to is we've spent a lot of time focused on the day one problem, but the lockup agreement is something else. Traditionally in an IPO, all of the insiders will get locked up for at least 180 days, and that's true with Musk here. Even though it's a bit looser than that, actually, even for his stake. But what they call the early eligible shares, which is basically, from what I can read, 90% of the non-Musk insiders. So basically, it's the only people that aren't in that are the executives on the board, right? So essentially, these shares are being dribbled into the free float, or being unlocked into the free float almost immediately, right? And by November, by the time they report Q3, right, almost 90% of the non-founder shares are going to be in the float. And so that is a constant draw on passive funds over the course of this summer to an enormous scale, right? I mean, you'd call it the November supply wall, but it's actually supply throughout the summer. And there is also a clause in there which triggers a release of shares as soon as the stock is trading 30% above IPO price. So, you know, there is supply meeting. You know, even if this valuation goes increasingly gaga, you know, there's going to be a fire hose of liquidity that comes into a price 30% above IPO price, which is kind of wild when you think about it.
Really wild. I mean, you know, I was talking to a guy this morning. He's like, "This is just crazy to live through." You know what I mean? Like all this stuff, it's just totally bonkers.
And let's talk about the multiplier effect. You know, we had Mike Green on earlier in the year, and people should recap that episode if you didn't catch it back then. But you know, we have, I mean, equity liquidity is not what it used to be, right? And there is a multiplier effect, right? We talk about $44 billion, you know, and actually that doesn't sound like a big number in 2026, but actually there is a magnifying effect, you know. And you know, if you use Mike's theory on inelastic markets, that 44 billion could feel like it's got a 20x multiplier. It could feel like $1 trillion.
22 is the latest numbers he's using, and you know, I was just reading one of his papers last night, actually, that he's writing, and you know, the idea is that liquidity is an illusion, right? And so, if you're going to actually put on real money, there's not going to be the ability to have elastic markets like we used to have. And there's a lot of evidence that shows that. So, yeah, I mean, 5 times is 250 billion, 20 times is $1 trillion, 25 times you're 1.25. I mean, so we, you know, Rupert and I were starting to think about, okay, what's the trade on that, right? Because like that's not a small amount of stock price impact, right? Like
I still don't think I can improve on the RSP, so the equal weight versus the mags, right? So long the RSP, short the mags,
maybe, but those things aren't liquid either. I don't know. It's
it's tricky.
Anyway.
I mean, it just you know, I mean, the whole US equity market could be, your words, an adult swim over the course of the lot. And what's extraordinary is we're only talking about secondary shares here. This is going to be a hungry hippo as a company over the next few years. I mean, the capital required to stick all of this junk in space, right? This is, you know, SpaceX is going to be doing ATMs every week, right?
Yeah, I mean, you know, the other thing I don't think we mentioned that is funny is if when you look at the S-1, the you know, we're going to raise 100 billion. Well, 20 of it's going right back to the banks. They're going to take almost $1 trillion in fees. I mean, $1 billion in fees, and they'll take their 20, you know, loan. They're shut that term loan down and bridge loan, whatever. And so 21% of the deal. If you go back to that slide for a second, because I think it's actually true. And you know, the thing we always talk, the capital recycling machine or bailout machine, whatever you want to call it. Elon is good at selling stock. He's maybe the best guy ever.
Best ever.
Right?
Best ever.
Probably the best of all time, right? And so that's the product. The product is Elon. The product is the hype, the excitement, the dream, if you will, the consciousness of the stars.
Or the ketamine addict man-child, depending on who you are.
I mean, but you're right, though. Like, you're going to have secondary shares coming. You're going to have the need for actual cash for finance. And I think, let me just put one little caveat to this, is you can take this down. There's something about this market that I think people are missing. Like, we go back to the .com. Well, who underwrote all that? It was the TMTs, right? It was the telecoms, and they all went under. They basically all, they all took a dirt nap, and then it was Amazon and Google and eventually Facebook and these companies that are these monsters now that rode on the back of that CapEx, right?
Yeah.
And so that CapEx was big. And the TMT was a proper credit cycle. And, there's a great book called Dead and Delusion by Peter Warburton. And he argued that that was the end of the cycle and that everything that happened post that, with the Maestro breaking the savings pact with savers and taking it to uber low rates, and then all the warehouse funding in the offshore dollar market and the euro dollar market, and they just tanked the dollar. And that's how we got the GFC. They basically didn't want to accept that it was over, and it was over. Like, that was, the dollar went down enormously just to try and keep the S&P, because the 1600 S&P high of 08 was very different than the 1600 in 2000 on the S&P. You know what I mean? In a dollar adjusted basis and a gold price basis and a euro price basis, whatever.
So what are the businesses that are going to get built off the back of this infrastructure that's been put out there? Because that's not, you're never able to see it at the time, and maybe this is an impossible question, but the thing about all of that dark fiber that was put under the sea and under the ground back in the early 2000s is that had a long shelf life, right? And these data centers,
that is what I took a little detour there. Sorry, viewers, as I'm sometimes prone to do, as Rupert knows. But yeah, that's the difference. Like, 20% of that fiber is still unused and it's laid, but it's long lived, right? When you build a factory, that's a 20-year plus asset, maybe a 40-year asset. Who knows? Power plants, long lived assets. This CapEx, now remember, in the data center, 75% is GPUs. Okay. So 25%, that's a long lived asset for the most part. You might have to do a little bit of rearranging for what.
You work on the aircon. You need to work on the aircon. You need to fix a roof from time to time. But yes, I agree. But
we don't know what the useful life is for that. And again, we talked about on Thursday. Basically, if the useful life of these GPUs is sub 4 years, we got a real problem. These neoclouds are probably zeros. Market's got a real problem here. Because, if you think about this year's CapEx, let's just call it 800 billion. They probably revised it up just a little bit, just to try and keep it going. Well, that means that 600 is GPUs, roughly, right? Mm-hmm. And chips and stuff. And that means that if you're at 4 years, 150 billion of maintenance CapEx a year on that level, right? So you're getting to the point here where this infrastructure, because the general idea that someone who hasn't really thought about it is like, you do the CapEx and then you reap the cash flows for the next 15 years or whatever, right? Like the general, when you're taught corporate finance of like, year one is the outlay, and then what's the payback period, right? Like super simple corporate finance math. Well, if you have a super high 20%, 25% type of, maintenance CapEx line, that's going to be a hog for a long time, right? And you got to literally bet on efficiency. That's basically what you got to bet on. Architecture, on the, like what we're doing in Second Brain, putting a memory layer on, of better chips, blah, blah, blah. You need the cost structure to come in your favor. But again, the GPUs I come back to, like I sent you that thing I did where I was like a couple like reports on the year one, year two H100s, the hoppers were holding up. Then you start to see a real jump down in year three. And we got a little bounce back. So I think that's one of the reasons why there's a level of excitement. But the who knows if it continues. And so that's really where we're at, is that all this stuff is capital heavy. And we've been living in a non-capital heavy market for a long time, right? Like for 20 some years. I mean, really, especially post GFC. And there's a lot of PMs and analysts on the street who just aren't really like that familiar with capital heavy businesses. And so I just wonder if there's like the combination of Mike's
depreciation was just an add back, right? This is a real bill. Yeah, listen, let's get back to this thing because I think we should wrap up pretty soon. But ultimately, I wanted to talk about the Goldman Stanley Goldman Stanley
Goldman Stanley and DJ Soul.
So, my friend Craig Coburn, who used to run global ECM for Bank of America Merrill Lynch, is going to kindly come on the show in a couple of weeks' time as we get close to pricing date. And he wrote an article in FT Alphaville last week, which was really amusing, which is linked in the note, talking about the bragging rights of the position in the syndicate. And to be clear, this was a bit of a shock, right? Morgan Stanley, put their reputation and capital on the line to finance the Twitter buyout and was sitting on that buyout debt for a long period of time, burning a hole in their pocket, right? Michael Grimes, who's the lead TMT banker at Morgan Stanley, followed Elon into government last year for a bit. And yet, apparently, we're supposed to believe that it was just DJ Sol sliding into Elon's DMs on Twitter that got Goldman, the left lead slot, which is insane, right? I mean, when I was working at Goldman, losing business was bad enough, but losing business to Morgan Stanley on something as high profile as this is just a cardinal sin. And that feeling was mutual on the Morgan Stanley side. So this has got a sting. Now, I'm going to put my tinfoil hat on here, and because I called this back in April. I'm close to thinking that this deal is undoable. Right now, that's the whole market is fading that view right now. You've got those 75% odds on Polymarket saying that it's going to be 2 trillion to 2 trillion plus at the end of day one. I'm just not so sure. This deal looks really hard, and even if they do pull it off, I think it could come like a wrecking ball through the broader equity market. I'm not sure anyone wants that to happen, and yet. What would Plan B look like, right? Well, Plan B, which would mean that Musk would have to give up that governance moat that he's built for himself in the SpaceX construct. Plan B would be a reverse merger into SpaceX. Now, there are challenges to that, right? But I think these are more sort of controllable challenges than getting this IPO out, frankly. And a 1% odds on a Tesla SpaceX merger by June 30, 100 to 1 shot. Yeah, I don't think that's a crazy bet. And as I said in my notes, I think it's probably got better expected value than buying SpaceX shares at a 1.75 trillion valuation. Listen, do I think that's going to happen? No, I mean, would I have anything more than a sort of joke bet on something like that? No, but I don't think it's crazy.
Yeah, I mean, I think the ownership thing that you mentioned is the challenge in that. But yeah, I mean, look,
well, he would have to
I
give
don't
up.
think XII was meant to be brought into SpaceX. I think it was just like he didn't have any other options, right? So yeah. Tesla is getting its ass kicked by BYD. Most of the other car companies have caught up with electric. We haven't had any kind of meaningful new Tesla car in a while.
It's a robot company now. Shush. It's a robot company now.
It might be. Who knows? But I'm just saying he's missed deadlines. FSD, Cybertruck was 3 years after he said it was. The robo-taxis, all I'm trying to say is...
Let's talk about the stock because clearly there are, there's a huge cohort of Musk believers that currently own Tesla, right? And I was, if you like, the easy trade would be to short Tesla into the SpaceX IPO because the fanboys have got to switch into Elon's preferred vehicle, feared baby. I think that's a dangerous trade though, right? Because of that 1% outlier, because RIP your shorts if this reverse merger gets announced. I mean,
Yeah.
that would be explosive. That really would be a rocket.
Well,
anyway,
well said. I think that's a good way to end it.
I think that's a good way to end it. We are back on Thursday. What are we doing on Thursday?
We have Michael DeClerc. He's a guy who did business in China in the 70s, did sourcing, because we wanted to talk about China, and Mike knows more about China. Like, he's forgot more about China than most guys outside of China know. And, he's not as much of a markets guy, but it's a good time to talk about China, because I feel as though you get a lot of talk from the West, from the Western angle. Rupert's in Hong Kong, and we can kind of take a little deep dive and talk about China, because China is obviously very important right now. And we have not paid attention to it enough recently.
Well, talk for yourself. No, I'm really looking forward to that. Listen, Benny, enjoy the rest of Memorial Weekend. And I will see everyone on the interwebs. Benny and the Squirrel out.